In 2008, Zimbabwe printed a $100 trillion bill. It couldn't buy a loaf of bread. Today, that same bill sells on eBay for about $40 as a novelty item. The irony is almost poetic. A currency so worthless it became valuable again as a collector's curiosity. But here's the question. Nobody asks, how does an entire country's currency go from functioning money to a novelty item? What actually happens, step by step, when a currency dies? When you hear about a currency collapse, the image is dramatic. Wheelbarrows full of worthless bills, riots in the streets, economies reduced to rubble overnight. The conventional story goes like this. A government prints too much money, people lose confidence, and suddenly their currency becomes toilet paper. Zimbabwe, Venezuela, the Weimar Republic. The moral of the story seems obvious. Don't print money recklessly. But here's what that surface narrative misses. Currency collapse is not a single catastrophic event. It's a mechanical process, a predictable sequence that unfolds in stages. And the real question isn't why governments print money. It's why rational people, acting in their own self-interest, systematically abandon their own currency. To understand how a currency actually collapses, you need to understand the 3 stages of dollarization. The technical term for when a population abandons its domestic currency for something more stable. Stage 1, asset substitution. It starts quietly. The domestic currency still works fine for daily transactions, groceries, utilities, wages. But if you're holding wealth, you start looking elsewhere. People move savings into foreign bonds or open dollar accounts abroad. Not because the local currency has failed, but because they want insurance against inflation or potential confiscation. Stage 2, currency substitution. Now the shift becomes visible. People still use local currency for everyday expenses, but expensive purchases, cars, real estate, business transactions, start happening in foreign currency, typically US dollars. Banks begin offering dollar-denominated deposits. If it's legal, people hold dollar accounts domestically. If it's illegal, they hold cash or accounts abroad. Either way, the local currency is losing one of its core functions. It's no longer the preferred store of value or medium of exchange for anything significant. The government often responds with price controls, hoping to stabilize costs. But here's the unintended consequence. When you fix prices below market rates, businesses stop producing, goods disappear from shelves. What's left gets hoarded, supply chains break down, not because of hyperinflation itself, but because price controls made it uneconomical to operate. Stage 3, unit of account collapse. This is the end game. People stop thinking in the local currency entirely. Prices become indexed to the exchange rate. Shopkeepers change prices multiple times per day to keep pace with devaluation. Wages, if still paid in local currency, become meaningless. At this point, informal dollarization is total. Businesses accept only hard currency. Workers abandon formal employment because salaries can't keep up. In Zimbabwe, during peak hyperinflation, teachers and nurses stopped showing up, not because they were lazy, but because their monthly salary couldn't cover a bus fare to work. The local currency hasn't disappeared from circulation. Bills still exist. The government may still print them, but they've lost the final function of money. Nobody uses them to think about value anymore. So what does a collapsed currency actually produce? First, economic output crumbles. Zimbabwe's economy contracted by 40% between 2000 and 2008, not primarily from money printing, but from the collapse in productive capacity that preceded and accompanied the currency crisis. When people can't trust their medium of exchange, trade becomes barter, and barter is inefficient. Second, the government's fiscal capacity evaporates. Zimbabwe's budget revenue fell from over 28% of GDP in 1998 to less than 5% in 2008. Tax collection becomes nearly impossible when the currency you collect taxes in is worthless by the time it reaches the treasury. Third, social services collapse. In hyperinflationary Zimbabwe, hospitals ran out of staff, schools couldn't function, and Harare went without water because authorities couldn't pay for treatment chemicals, all because the government's ability to purchase goods and services had disappeared. When money stops working, legitimacy dissolves. But there's something deeper happening here. The death of a currency is ultimately the death of a shared belief. Money only works because we collectively agree it will. You accept it today because you trust others will accept it tomorrow. When that trust breaks, when people stop believing in the future value of their currency, no government decree can restore it. You cannot legislate trust back into existence. History shows this pattern clearly. Hyperinflations cluster after wars and during political chaos. Post-World War I and World War II, the dissolution of the Soviet Union and civil conflicts. Currency collapse doesn't just reflect economic mismanagement. It reflects a breakdown in the social contract, a collective loss of faith in institutions. The final consequence is this. Once a currency fully collapses, restoring it becomes nearly impossible without a fundamental change in political credibility. Zimbabwe has introduced 5 separate currencies since 1980, all of which ultimately failed. Today, the currency most widely used in Zimbabwe is the US dollar, a recognition that trust, not just monetary policy, is what makes money work. Zimbabweans weren't choosing superior American monetary management. They were choosing a currency backed by an economy and institutions they could believe in. Here's what most people miss. A currency collapse is not fundamentally about money printing. Yes, governments expand the money supply during hyperinflation, but the money printing is usually a symptom, not the cause. The underlying problem is a collapse in productive capacity, combined with a government desperate to maintain spending when it has no other way to finance itself. Consider the cases everyone cites. Weimar Germany's hyperinflation followed its defeat in World War I and the Treaty of Versailles, which demanded reparations in gold or foreign currency, not German marks. Germany couldn't earn foreign currency because its productive capacity was crippled. Printing marks to buy foreign currency accelerated devaluation, creating a death spiral. Zimbabwe's collapse began with the seizure of productive farmland, which caused agricultural output to plummet and food prices to surge. The government then printed money to finance a war in the Congo while facing international isolation. Hyperinflation was the result, not the cause, of economic collapse. Venezuela's crisis emerged from oil dependency, price controls that destroyed private production, and a government that chose monetary expansion over fiscal adjustment when oil revenues fell. In every case, the sequence is the same. Something destroys productive capacity or external creditworthiness. The government, unable to finance itself through taxes or borrowing, prints money. People seeing this rationally protect themselves by shifting to foreign currency. The shift accelerates devaluation. Devaluation drives more money printing. The cycle feeds itself until the currency is abandoned entirely. The insight: currency collapse happens when a government loses the ability to tax or borrow, not when it gains the ability to print. And here's the corollary. In countries with strong institutions, diversified productive capacity, and access to external credit, hyperinflation is exceedingly rare, even when deficits are large and money supply expands. The United States has never experienced hyperinflation, not because it's cautious with money creation, but because its currency remains anchored by productive capacity and global demand. The real lesson of currency collapse is this: money is a claim on an economy's output. When output collapses, whether from war, expropriation, corruption, or isolation, and when institutions lose credibility, the currency follows. No amount of monetary restraint can save a currency when the economy beneath it has already failed. Thank you for watching, and we hope you enjoyed the video. If you're liking our content, please show your support by hitting the like button and subscribing to the channel. We'll see you in the next video.